Every generation believes it's living through the most dramatic disruption in history. Ours happens to be louder about it. Between artificial intelligence, platform economies, and geopolitical flux, it's easy to conclude that traditional investment analysis no longer applies. But this belief is not only mistaken, it's dangerous. What has changed is the volume of the noise, not the underlying structure of investing. Valuation, at its core, remains a grounded exercise in estimating future cash flows, adjusting for risk, and thinking clearly when everyone else is either euphoric or panicked. In a world awash with novelty, the real edge lies in old-fashioned discipline. The railroad changed economies. Electricity rewired labor. The internet redefined scale. Every era has its disruptions. What distinguishes our time is not the pace of change, but our exposure to it. Real-time data, social media, and algorithmic news mean we feel the tremors more viscerally than ever. But feeling disruption is not the same as facing analytical chaos. Disruption, historically, has always created temporary distortions, narratives that soar beyond fundamentals. Today's unprecedented is yesterday's transformational. Investors who confuse novelty with value often find themselves overpaying for potential that never cashes in. The smart response isn't avoidance, it's analysis. Disruptive does not mean unvalued. It means harder to value, and that's where skill shows up. Accounting systems were built for an industrial economy. They're still trying to retrofit that logic to a digital one. As a result, modern businesses, particularly those built on code, content, or community, often look asset-light and earnings-light in the short term. But the reality is, these businesses can be more cash-rich and scale-effective than their asset-heavy predecessors. Valuation frameworks need to evolve accordingly. The absence of traditional book assets doesn't mean the absence of value. What matters is the durability and growth of cash flows, not whether they're tied to factories or to networks. In many cases, intangible-intensive businesses offer greater predictability and monetization than tangible ones ever did. Investors like to believe they make decisions on logic. In practice, fear and regret dominate. The fear of missing out leads to rushed entries at inflated prices. Regret drives exits just before inflection points. Narrative momentum makes analysts contort models to justify what they emotionally want to believe. Combating this requires structured psychological discipline. Documenting assumptions, keeping valuation journals, running worst-case scenario exercises, these aren't academic. They're shields against self-deception. The difference between a good analyst and a great one isn't who has the better spreadsheet. It's who has the clearer mind under pressure. Too often, growth stocks are seen in binary terms, either wildly overpriced or unjustifiably dismissed. But growth can and should be valued rigorously. The key is not the level of growth, but the return on capital that drives it. If a firm reinvests heavily but fails to earn more than its cost of capital, its growth is value destructive. Understanding growth means tracing reinvestment loops. Where does the money go? What are the incremental returns? And crucially, what is the margin of safety between projected returns and funding costs? The goal isn't to model certainty, it's to identify asymmetry. That's where patient capital wins. Some risks can't be diversified away, only discounted. One of those is government intervention. Investors learned this the hard way in markets where political whims override market forces. When a regulator can erase billions in value overnight, the discount rate must rise, regardless of what the spreadsheets say. This is more than just country risk. It's about recognizing the asymmetry of trust. In some jurisdictions, laws evolve through consensus. In others, they mutate through decree. This fragility needs to be reflected in valuations, not after the crackdown, but before. Failing to account for it is not optimism, it's negligence. For much of the past decade, low interest rates allowed investors to stretch valuation logic to its outer limits. But the reappearance of real rates has been a brutal reality check. Suddenly, long-duration assets, those with cash flows far in the future, face heavier discounting. Equity risk premiums must adjust accordingly. A 5% risk-free rate forces investors to demand more from equities, not just more growth, but more certainty. Some corrections, especially in speculative tech, weren't overreactions. They were reversions to sanity. Macro may not be predictable, but it is priceable. The most investable opportunities are often the most uncomfortable. Biotech firms with binary outcomes, climate tech startups with uncertain monetization, AI ventures with unclear moats. These aren't avoidable puzzles, they're the ones worth solving. Trying to value the unknown may feel futile, but it's not. The goal isn't precision, it's structured inquiry. Scenario models, decision trees, and probability-weighted cash flows help turn uncertainty into investable insight. The alternative, relying on instinct and momentum, is not a strategy, it's a hope. The world may look different. It may feel faster. But the principles that separate real investors from speculators have not changed. Cash flows remain the anchor, risk remains the compass, discipline remains the edge. Investing today isn't harder, it's just louder. The temptation to follow the noise, chase the story, or abandon analysis is stronger than ever. But those who stay grounded, who value the intangible, manage their psychology, and lean into discomfort, will find that clarity still cuts through the chaos. Valuation still works, but it demands work.